No, I think that the investing in quality generally, you have to definitely embrace that uncertainty because, one of the appeals, I think, of the older sort of Ben Graham style of investing where you could look at something and you're buying in it below book value, let's say, is that it gives you that anchor and you feel more comfortable, buying something below book value or buying something at a very low multiple. But most of the time when you're buying a really great business, it's very, very difficult to put any kind of intrinsic value on it per se. It's like you say, it's compounding capital high rate. Directionally, it's going to be worth a lot more money 5 years or 10 years. You don't really know how much more. But you have that bunch of possibilities. You just don't know exactly where to go. And you have to be able to embrace that.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on the show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is Chris Mayer. He's a professional investor, best-selling author, expert on general semantics, and more. He is a portfolio manager, a co-founder of Woodlock House Family Capital, and the author of 100 Beggars, How Do You Know, Dear Fellow Timebinder, World Right Side Up, and Invest Like a Dealmaker. Chris, how are you? So nice to see you.
Thank you. Thank you for having me on. Good to see you.
So this is the third time you're on the show. There's a handful of people in the last 100 episodes that came back 3 times. So I'm so grateful to have you back.
I'm honored.
I told you that the 2 episodes, one about 100 Beggars and one about general semantics, are still among the top episodes downloaded by people all those months. I think it's been a year since one of them came out. So I've heard so many wonderful comments about the general semantics episode that I highly recommend to anybody just tuning in to have a primer for this conversation. And I mentioned to you that I'd love this conversation to be a bridge in a way between the 2 conversations. And I'd like to add a few things that you and I talked about that were not part of the show that I think would be of interest to this audience. I want to jump right in, and I will not ask you about your childhood and upbringing. I already did. But I've been curious. You've been professionally managing money for a while. And I'm curious what the experience taught you about investing, running an investment practice, and most of all, keeping clients happy.
Yeah, good question. I think one thing it's certainly emphasized to me, not that I didn't think about it before, but the experience has made it more important, which is the idea of communicating very clearly with your investors. and really working on that without, and being able to explain your investment process and ideas without a lot of jargon, without, losing them. Talking to it like you would talk to a normal person who was not in the investment profession. How would you describe it? Dropping all the jargon that we tend to use. That's very important. And then repeating that and continuing to hit on that in all your communications to your investors. So there are 4 points that I talk about all the time with my investors. I talk about balance sheet, skin in the game, high returns. Those are like the big three. The big three I talk about all the time. And just repeating them all the time and showing that how your ideas fit, so that you are showing them that you're doing what you said you were going to do. And I think that's important, because then they're on board with you, and then they're able to ride out the rough patches, which invariably will come for everybody.
And I think that's key, because it's relatively easy to find a client in a good year, so to speak. Everything goes up, everybody looks smart. But I think you really get to know yourself and your clients in those years when these are tough conversations. March 2020, I remember taking some calls, I shared it with you. But these are the times when you really get to know your clients and they get to know you. How would you react? And we can hypothesize about it on a nice day. But then when it actually happens, how do they react? Will they stick around? Will they allow you to think long term, hold on to the stocks you have? And I think that's when we learn a lot. Is that how you feel?
Yeah, exactly. And the other thing I do is I do 2 calls a year with investors. I do like a spring and then like a call toward the end of the year, where I just give a very short presentation, like 10 or 15 minutes, and then just have some Q&A. So again, that gives them a chance to ask questions, to see how you respond to different questions. And I think it makes it more personable too. They see you as a human being trying to figure things out as you go, and they get on your side, versus if they hear from you only once a year and they get this long letter that nobody reads. And so I think those things are important. And I think it can be a competitive advantage for you as an investor to have capital that you can trust and know will be there, and that you won't have the rug pulled out from under you, so to speak, when you get into those times like March of 2020.
I think we make the biggest difference in those moments, though. On one hand, because we don't panic, we don't sell. And on the other hand, that we actually go out and buy. I was buying things in March of 2020, but that's only possible.
we keep our investors from doing something that they shouldn't do. We hold their hands through those tough periods so they don't pull the plug at the absolute wrong time.
There you go. Yeah, that's very true. You brought up skin in the game, and I was thinking about the purpose of your firm. You talk about family wealth, and you have this quote on your website about not turning it over to Wall Street, traditional Wall Street. I'm guessing you're thinking about this sales-driven, very active, transaction-driven mindset, and people who don't have the skin in the game. You're doing the opposite, and you're thinking about family wealth, and that's where the firm originated. Can you talk about that aspect? Because it resonates with me. I manage money for families, and it's been my business for the last 2 decades. And I grew to appreciate that it is families with a long-term view. But I'm curious about your perspective.
Yeah, it's kind of a pushback against the asset gathering mentality of most, we call traditional Wall Street firms, where they spend quite a bit of time raising assets. And the money managers, the investment managers, also spend quite a bit of time on that activity, meeting with investors, meeting with asset allocators. So, Woodlock House was a pushback against that, and also a pushback against the transactional nature of most of Wall Street. The sell side always gets a lot of criticism, but they exist, I think, in part to generate transactions. So that's buy, sell, hold, change it multiple times. Whereas with a family that you don't particularly care about that, you're thinking of these investments like they think about real estate. You buy it and you're going to own it for some long length of period of time, and you're not so concerned about what the price is in between those periods. So those are two, I think, important pillars why I think families are different.
It allows you to take a long-term view as an investor, and they see themselves as business owners. I mentioned it in one of my essays. The families that I work with, you can trace back the wealth, and usually if it's a business, it's an income-producing asset that created that wealth. It might have been one business, and now it's a collection of businesses, a stock portfolio, but that's all it really is. We take stakes in businesses we want to own for the long period of time, and families intuitively understand it, and they operate on a whole different level, with a whole different mindset than most of the activity that you see out there that is counted in days, if not minutes, in terms of holding stocks. So in my mind, it's a huge advantage because you can wait.
I think so. And they understand that businesses don't always go up and to the right every year, that there are periods where they disappoint and where you're got to work through a struggle. But yeah, they definitely understand, because the reason you said, they also own businesses, so they know what can happen when you own an asset like that over 10, 20 years period of time, the amount of wealth it can create.
People forget that, but compounding needs time. And to have that kind of time horizon, you have to wait for things to happen. And I think Morgan Housel is the one that brings it up, how Buffett made 95 or 98% of what he has after the age of 65, was it? And it's mind-boggling, because I think our minds mostly think in terms of linear experience. I have one apple, I have two apples, I have three apples. But compounding, especially down the road, decades into it, the growth is just exponential. And the idea that Buffett has holdings that pay in dividends more than it costs him to buy those assets, I think you have to ponder for a second.
I think of Chuck Akre, always has the example he likes to talk about, a penny doubling every day for 30 days.
Mm-hmm.
And I think it's $5 million it comes to, or maybe it's 31 days and $11 million. I forget the exact math. But the point is, there's a lot of money. But the second point of that is that, let's say it's 30 days. On the 29th day, you have half as much. On the 28th day, half as much again. Mm-hmm. So you can really see that back-end nature of compounding. And yeah, I would encourage people just to work it out on a spreadsheet and just see. Take 15% a year and just throw it out for 20 years and see how the numbers grow. In the beginning years, it's kind of a little bit of a slow grind. It takes you 5 years to double. Mm-hmm. But then things happen very quickly after that. And the numbers can get big after 20 years of doing that.
Very much so. When I look at the family fortune, I tell families, don't see it what it is today, but think of it what it could be, 10, 20, 30 years from now. And I've seen family fortunes double and double again. And over 2 decades, you can really see massive growth if you don't do anything silly in between, which is a whole different topic. I'm curious about The 100 Beggars. The book came out almost a decade ago, and I was rereading it the other day and taking some more notes for this interview. And I was thinking, how do you see it? How much has changed in those 10 years, both in terms of more opportunities and more challenges for somebody who is looking for a stock that could go up 100x? How do you see it?
I'd say the thing that changed the most is the accessibility of good research.
Mm-hmm.
There's a lot of free stuff on Substack.
Mm-hmm.
There's a lot of company write-ups that just proliferate out there on the internet, and people are doing good work.
Mm-hmm.
And it's free. So there's just so much more of that now than there was 10 years ago. So in some respects, it maybe is easier because there's more for you to look at and read, and more people for me to learn from and even interact with. There's comments, and you can reach out to people so easily nowadays.
Mm-hmm.
So that part has gotten a lot easier. I think even 10 years ago, it was still there, but there was still a lot more that was gated, a lot more premium subscription services and things. So I think that's the biggest change. I don't think there's been any particular change in markets per se. It's still the same game, the same people, some different names, but I don't see that part of it has changed so much. I think it's just that accessibility, and then even on things like platforms like X, there's just a lot more out there about everything. Now, that can also be a negative because sometimes there's just so much about nitty-gritty things and quarterly numbers and worries about, still the same thing. Everything gets amplified, even the short-term concerns and worries. So I guess it comes, like most things in life, there's a positive and a negative.
I was rereading the book and I was thinking anybody can buy a stock, but very few people can hold it. And if there's one big message from your book, is that you have to hold it, right? So
yes,
you might find the right, analyst writing up with lots of detail the business you're curious about, and maybe that research will fill in the gaps and maybe even convince you to buy it. But it's a long journey from buying it to actually holding it. And the book points out that there will be ups and downs. There will be periods when the stock is dead money. It just goes nowhere. It will test your patience. And if you're managing other people's money, they will ask you, Chris, why is that still in the portfolio?
Yes.
And I think
yes.
that has not changed. I think that's a permanent feature of the experience of stock investing.
And sometimes I think the dead money is harder than the drawdowns.
I think so too.
Drawdowns tend to be quicker. You have a stock that draws down 30, whatever, 40%, and then it rebounds. But the dead money, you study some of the records of those 100 baggers. Some of them, it was years where they were dead money.
Mm-hmm. Mm-hmm.
And again, when you're managing other people's money and you've got a track record, and it makes it hard. 4 or 5 years of going nowhere, and then it could double on year 5 or year 6, and then suddenly your overall IRR looks pretty good. But for a long time there, you didn't look like you were doing much. So, yeah, that's a great test of fortitude.
The other thing that I bring up in my writing and on this podcast is that I'm very comfortable buying something that makes sense to me but has no immediate catalyst. And I think a lot of people are obsessed about the immediate catalyst. Tell me why it will move. And sometimes I can't identify or get comfortable around a catalyst, but I feel like I'm getting something that makes sense. I'm a value buyer, growth holder. If you had to pigeonhole me for a second, that's how I would describe myself. But then I noticed that a lot of investors, if there is no catalyst, they can't participate. And I've heard it even from people that are responsible for big endowments. They tell me if there's no catalyst, they can't put it in the portfolio. And I thought that's very limiting. How do you think about it? You need a catalyst? Or are you okay without having one?
No, absolutely not. It's nice to have some out there,
sure,
things that you're looking forward to. But catalysts I have would be things that just happen organically, just owning something you start to appreciate. Maybe even you didn't even know about it when you bought it, but a year or two in, there's maybe an acquisition that's exciting or something's happening that you didn't even know about. So I don't think, I can see why people would feel that way, because sometimes I'll get that too. People say, yeah, that's great, but what's going to make the stock go up? Like you need some special attention, something's going to happen, makes it go up. And for me, I think it's more like building a wall, brick by brick. Every year they're putting in more cash flow, more, and it just keeps going up and up. And over time, it becomes an impressive wall.
Very much so.
I don't need any specific catalyst.
I've been thinking about the word risk and uncertainty, and more so about uncertainty. And it's such a tricky word. And you and I talked about the language vocabulary before, and we'll talk more about it in a second. But the word uncertain, when people tell me, the time is uncertain, the stock is uncertain, the industry is uncertain, I ask them, what do you mean? Because to me, uncertain can be actually positive, right? So I thought the stock could only double, but it goes up 10x. Well, I am uncertain about the outcome, but directionally, I was right. It's a bigger, better business over time. And I think getting comfortable with the fact that there is uncertainty, it's key, especially if it can be a more positive upside uncertainty. I don't know how much money I'm going to make. Is it going to be 100x? Maybe. But if it's a 50x, I'll be okay. I'll still call Chris and tell him about it.
Yeah. No, I think that the investing in quality generally, you have to definitely embrace that uncertainty because, one of the appeals, I think, of the older sort of Ben Graham style of investing where you could look at something and you're buying it at below book value, let's say, or is that it gives you that anchor. And you feel more comfortable, buying something below book value or buying something at a very low multiple. But most of the time when you're buying a really great business, it's very, very difficult to put any kind of intrinsic value on it per se. It's like you say, it's more of it's compounding capital, high rate. Directionally, it's going to be worth a lot more money 5 years or 10 years. You don't really know how much more. But you have that sort of bushy tail, bunch of possibilities. You just don't know exactly where to go. And you have to be able to embrace that.
Would you see it as a static and a dynamic interpretation of value investing? Because a lot of people talk about the value investing 2.0, 3.0, and I find it really interesting and intriguing. But when I really think about it, when you brought up Ben Graham, it was a very static way of looking at things. I'm buying $1 for 50 cents, and then I walk away and I have to reinvest it into something else. I wasn't there in the 30s. I can only imagine what it was like with a lot of, half-dead zombie companies with more on the balance sheet than they're worth and so on. So you could do the math if you knew how to, and he did. But then we're thinking, and I'm thinking of kind of a dynamic, which is the 100 beggar idea. It's $1 billion company today. It could be $100 billion company down the road, right? It's dynamic. Will it be? I don't know. But it's a dynamic way of looking. So a couple of things happen. One, I do have to wait, but I don't have the reinvestment risk or challenge, right? Because if I bought the right thing and it keeps compounding, as you said, it keeps compounding unevenly, right? Not each year the same amount, of course, but I can just keep on holding it. I did the work. I can keep on holding it. It's much more attractive when you think about it. I'm not saying it's easier, but it's very appealing. Right.
Absolutely agree. I remember I heard a money manager say, I forget where I saw this, but he was criticizing kind of this high-minded value approach that we're talking about. And at one point he said something like, well, Warren Buffett, all I know is Warren Buffett would never walk away from a 50-cent dollar, basically. But I was thinking to myself, well, I mean, I don't know. I think if you think of it in those static terms, it sounds so smart. But if you knew your 50-cent dollar was only ever going to be $1, and you could buy something else, let's say you could buy a dollar, but let's say that dollar you knew could be worth 10, you'd be much rather put that money towards buying that dollar. You might even pay $1.50 for that dollar today if you knew it was going to be worth 10, 5-6 years from now. So, yeah, I think you're right. I mean, people frame it in these very static terms, but companies grow and value has the potential to really increase exponentially. And it totally reframes how you think about the present price.
And it's something we don't talk about, the reinvestment risk, right? So I have $1 million. I'd like to put it to work. And let's say I do find the 50 cents and I get $1 at an odd time. I don't know, 6 months from now, 18 months from now, it's still a decent return, right? Even if it's 2 years from now. And I get the money back at a time when I might not be able to find anything that fits that formula for a while, right? The reinvestment risk is a very real consideration when you have to put the money again to work. And usually it's at a time when you can't find something that fits. I mean, Buffett got to the point that he ended up winding down his partnership because he said, I'm not finding anything that makes sense. And he distributed Berkshire shares to his partners. But there are moments where wouldn't you rather have something that continues to work over the long run? I know it's a revelation that happens down the road, and I definitely transitioned from trying to find the static discount to finding a dynamic discount. And I'm not saying it's easier, but I feel like it's an open-ended opportunity.
Yeah, that was seared. That kind of thing was seared into me from 2008 because I remember buying stocks for net cash and being very excited about the valuations that you could get on things. Of course, 2 years later, I'm out of all those things and I've made decent returns. But like you say, now I have the cash, and now what? You have to find ways to put that capital to work in much different markets, and you have to pay taxes. So I would much rather had bought, if I could go back in 2000, I'd much rather would have bought like a MasterCard or Visa, or I think they went public that year.
And they were down 50%.
That I would probably still own today, right?
I think they were down 50% soon after they went public because there were some big concerns about regulators coming in.
I remember looking at them.
I remember that. Yeah. Very much so. I have two quick questions related to the world being different these days. So one, when I was reading Peter Lynch, 25 years ago, One Up on Wall Street, and he was writing about something that happened 2 decades earlier, the 80s, he would find those companies that would get listed, and they would be a retailer or a hotel chain that was local, regional, and they would roll it out coast to coast. A lot of those ideas were basically, if it works in the Northeast, it could work coast to coast. At least that was one of the themes. The reason I'm asking is because I have this impression that a lot of businesses get listed very late these days. They're already in 100 countries, right? They have funding longer than historically, from what I understand. And they obviously get listed as $50 billion companies instead of a $2 billion company. I'm wondering if you think that has an impact on how much of that 100x runway we can capture as public equity investors.
Yeah, I think framed that way, absolutely. Companies we're seeing are more mature on average than in years past. So, but maybe one mitigant to that would be that you can certainly invest more broadly now than you could then. I mean, if you include all of Western Europe and North America as a bucket, that's a very extensive pool of securities. And there's maybe you could also argue that some of these companies, their upside is still larger because the markets are larger than they were. So companies are more mature, but there's just more opportunity just generally. This reminds me of one thing I think about a lot with, I remember recently because I had a conversation with an investor who was kind of hung up on market caps. And he was talking about whether something was small cap or large cap, and was sort of worried that if you owned something that was $50 billion market cap, that its upside was somewhat more limited than if I spent my time buying something that was $1 billion, let's say.
Right.
And it got me thinking that, everything's relative, right? I mean, a $50 billion company could be small relative to some kind of global opportunity, global marketplace. And $1 billion company could be very large relative to some niche industry that it's in, and that it has the majority of the market share and it's not growing much. So you really got to get past this idea of necessarily market caps and sizes in isolation, and always have to be compared against the opportunity set. So, roundabout way to getting at that question that might be true. It's more limiting, but it may not be.
I think the runways are longer. I think that's the point you're making. Because if the service works in the US, then it could work probably in 50 other countries. But if it works in 50, it should be available in 150. And I don't want to pinpoint any companies, but all the newer ones from the last 10, 15 years that dominate our life. I call them global, ubiquitous, and with serious profits.
Right.
They are such a big part of our life. Wherever we show up, we use their services. Their runway is so much longer than a runway of a regional retailer that had something appealing in the 1970s, right? That's how I would look at it.
Yeah, that's exactly better put than I did. Yes, that's it.
I want to ask one more follow-up question. Passive investing. It's been on my mind, and I had one guest who spent a lot of time researching passive investing and negative consequences of having it, and the whole intention that passive investing was supposed to piggyback on active investing, and now that depending on the measure, more than half, maybe 60% of assets is held by passive. But there's something that has changed in the dynamic of the market, and I'm still trying to understand. But if you have companies where index funds hold the majority of shares, and there is no longer a founder, or if there's a founder, they don't really have a lot, then you have a lot of passive participation. It means to me that nobody's actually looking at the business, the fundamentals. Nobody's making a pricing decision in terms of I should buy, I should sell. There's really almost a one-way street until there isn't, where more money is added passively, but nobody's questioning if this business is really worth $50 per share or not. There are fewer participants that do that. And I think it can create a couple of interesting phenomenon. We have those gap downs in very large caps, 20-25% in a day or two. That's one thing that happens. On the other hand, it feels like there could be more opportunities for mispricing and the market basically not paying attention. So on one hand, you have those Substack analysts that do in-depth research that I hope some people read and act on, depending on their own needs and judgment and everything else. But then you have this passive block of participation that is not looking, not asking, not questioning. They're just in for the ride. And even Bogle himself said that at a certain point, this leads to chaos. I wonder if in your mind that could actually lead to more opportunities for those hunting for 100 baggers.
I mean, it could, especially if there's some movement between. When a company is, of course, added to the index, it gets a tremendous pop. And when a company is dropped, likewise, you get a little short-term pop. I don't know about the long-term effect of those, whether it matters so much. I certainly think in shorter-term sort of money flows, it definitely matters. But at the margin, I don't know what the level is where pricing becomes very inefficient. I know I've read some papers on it, and they're sort of all over the place as to what the effect is. So I think the jury's still out on that. I think where it definitely has an effect, though, is where on matters of corporate governance. And so it's very difficult when you have the largest shareholders are all ETFs. It makes it more difficult, I think, for shareholders to change things. It makes it easier for management teams to get entrenched. It makes it easier for them to pay themselves lavishly and justify it using expensive compensation committees that use consultants and so on and so forth, which is probably not the best thing for shareholders, versus a company where you have more active owners are the largest shareholders and they pay attention and they may even be on the board. I think that's where you can get very different outcomes. And again, I don't know what the effect will be. Longer term, it would seem to be that you could have some large differences. It might be something akin to research that we see on family-owned firms outperforming non-family-owned firms, or companies with a high, like I've seen research when the CEO owns a higher percentage of shares, outperforms companies where the CEO doesn't own a large percentage of shares. There's a lot of research around this insider ownership question and how it's defined. But maybe there'll be something along the lines of what types of shareholders you have. I know Larry Cunningham has done work on quality shareholders, and I think his research has indicated that quality shareholders can be an indicator of outperforming stock. So maybe this falls into that sort of rubric where you'll have passive investors. These giant ETFs will not be seen, not quality shareholders, and so as a group, they will perhaps underperform a group of companies where you have high quality shareholders.
I feel like you need an owner, somebody that will actually watch. And it's good if it's a founder, right? If it's a founder or a family, that's great. Or if it's a group of shareholders that have been around for a while, that helps. Years ago, I got a phone call from a CFO of a company that I was holding at the time. And I was surprised why they wanted to talk to me, because it wasn't a big position for me. But they went down the list and they had nobody to call because it was all ETFs. And they said, well, we're calling you because...
Yeah.
You're a person, you're a human we can talk to, because you can't really talk to an ETF because they don't even really care that they hold the shares. Yeah. They have to hold the shares.
Right.
But that's...
And, I mean, they can't possibly vote. I mean, they can't possibly know their companies well. I mean, you can just look at the number of people that work at these, at large ETFs and the number of companies they own. Think about the number of proxies you'd have to read. I mean, it's not possible. It's just, so, so they're relying on services like ISS for advice. And then you get kind of weird things there too, because as you know, you probably heard about an independent board member is something that's valued by those kind of services. But investors like you and me, we don't care about that at all. We'd rather have a board full of owners than anybody who's independent and doesn't own any shares. So you get some strange outcomes that way.
Yeah, I'm curious where it goes. I want to ask you about your experience investing before you discovered general semantics and after, if there's a way to look at it, and how you think that has influenced how you invest, how you think about investing, because I feel like this pursuit provided you with a set of mental models to interpret the world in a different way.
Definitely has, and it has also provided ways to ask questions. So, yeah, I mean, I always say the easiest kind of examples to talk about have to do with labels and the way we think about and use labels. And general semantics has a way of sort of cutting through all that. So we mentioned, market caps, but it could also be just even the ideas of thinking about stocks, or certain types of stocks. People say it's a value stock or a growth stock, and I don't pay any attention to that anymore, just because, what do those things really mean? I mean, they don't. When you really think about it, they don't really mean anything. It's just it's a label that one group of people have stuck on a stock, and another group of people may differ, think differently about it. So, market caps, we mentioned the idea of even people will say, well, this is a U.S. stock or this is a, European stock. Even that I don't pay much attention to that, because you could have a stock listed in London, but 90% of their business is outside of the U.K. So what good is it to classify it that way? So, sometimes it's hard to come up with specific examples. But I think that's probably the biggest way. It's just changed the way I think about labels, using and the way other people use it when they describe certain things, and then asking good questions. I think general semantics provides a number of tools to ask questions, and it helps you keep a view of the world that's not static. And we talked about one of the big ideas, important ideas in general semantics, is the world is always changing. So Krzyzewski had this idea that even when you did describe something, you might use a date to note that is your opinion as of right now, but that it may very well change. So, you take a look at, let's say you took a look at Copart in 2020 and you passed on it for some reasons, but that was your point of view in 2020. And your view in 2024 may be very different. And the companies themselves are not necessarily the same either. So just because it's, we talk about Berkshire Hathaway as if it's been the same entity all along, but it's changed quite a bit over time with different acquisitions and what companies contribute most to earnings versus what don't. So all those kinds of questions really fold into it. And once you really get into it, it will just, it gets into you. It changes the way you think and look at the world generally.
What I liked from our conversation, so many things, but the one that stayed with me was English as a language without absolutes. And I catch myself still using, since our conversation, using always, never, everybody, nobody.
Yeah.
And it's a shortcut. We just use it because it's so easy to say. But then we realize, as you said, no value buyer would buy this stock. Why is that so? And this is not a Buffett stock. Buffett would never buy that. And we've been proven wrong. He surprised us with some purchases. But I think seeing world is much more nuanced through space and time and notion. I think it opens our eyes to more opportunities, looking for the 100 beggars too. I had a conversation with somebody about the hotel industry. And some people say I would never own a hotel stock. But hotel stocks today and 20 years ago are very different hotel stocks. Back then they owned the real estate. Now they don't. Back then the loyalty programs were not as developed as they are today. It's all app-based. People are really loyal to their brands. They get points, rewards, discounts, upgrades. So on many levels, it's a different business today. It's asset lighter or asset free in many ways, and you have a much more loyal customer base, and fewer players and so on, and brand loyalty. So when you say I would never own a hotel stock because of what you remember from 20 years ago, how about you take a second look? I'm not endorsing hotel stocks, but I think it's worth looking again, right? Like any industry you think you would never go. And the opposite, the industry that you are in love with, it might be a different industry today too, and maybe there's no point in having those stocks in your portfolio, but a more nuanced way of looking at it.
Definitely. Yeah. World's always changing. That's a key idea. Another key idea is that you can never say all about anything. So, whatever you're describing or doing the work on, I always think mentally, Krzyzewski, again, was a big proponent of using et cetera. So whatever you say about something is always, mentally, at least you have a little et cetera in there, that there's more things that you're not capturing or that you don't know. So that comes into making you a lot more humble about what you think you know.
Okay.
So yeah, those are just some of the ideas that I think are important.
Very much so. And feeling like a student all your life, you get all the degrees at the young age and you feel you're done with school and what else should you know? And you realize, no, this is just a license to learn. You have some foundation, some understanding. I was having dinner with a friend who's in college and studying philosophy and getting the early mental models to use in life. And I feel like how exciting, because it's the beginning of the journey and there's so much more to learn. But speaking of philosophers, there's a quote in the dear fellow Time Binder that I really like. I want to bring it up. You say, we can read Plato and Galileo and Newton and Darwin. We can pass on complex ideas across many generations. We inherit plans and recipes, a treasury of know-how and experience on which we can improve and create new and better plans and recipes. And in Krzyzewski's words, we are inheritors of the bygone ages and the trustees of posterity. So I'm curious, what are the big ideas that you would like to have engraved somewhere for the future generations to read and get started with on their journey? Are there a few that you could share?
Well, in the context of this conversation, I'd have to say that at least if they were going to be involved in investing, I would definitely love to see those ideas of 100 to 1 with Thomas Phelps, and that I've also tried to state in my 100 Baggers book, that people really learn and understand that power of compounding and the nature of it, like we talked about, the back end nature of it, the nature that's volatile, and all these things we've talked about. Those are really key ideas. And sometimes I wish, if I had learned it when I was earlier, I would maybe. But then I check myself because you always have a journey you have to go through a certain way, and if I did learn those ideas earlier, maybe I wouldn't have the same appreciation for them, or there's lots of things that would be different. So I had to go through it the way I went through it, and maybe that was my role also, is to go through that and then be able to share the journey and share those ideas. So that would be one. And yeah, I do love the Krzyzewski's ideas. He was himself more of an engineer, more of a mathematical background, so he wasn't really the best expositor of his own ideas. His book, his main work called Science and Sanity, is a big, huge, fat book with lots of footnotes and math in it, and it's repetitive and not necessarily well organized or particularly well written, but the ideas in there are very important. So I am actually also on the board of trustees for the Institute of General Semantics, so I think it's important to preserve those ideas, and in now 2 books, I've tried to distill those ideas down to what I think are the most important, most critical to know. So both in How Do You Know and Dear Fellow Time Binder. So both of those are ideas that I've kind of now dedicated my adult life to in a way. So those are ones I would certainly like to see continue on.
And I think you've done an excellent job introducing us to those ideas in a way that's more accessible maybe than reading the originals, which is sometimes the case.
Absolutely, yes.
In a more contemporary way and also in a more accessible way. And I highly recommend the 2 books. As I'm listening to you and thinking of 100 Baggers, an idea popped into my head that I want to bring up. There was a movie, The Life of Adeline, or Time of Adeline, about a woman that lives for 100 years because of an accident. I don't know if you know the movie, but she ends up buying shares in Xerox before it was Xerox. And she meets an investment advisor or a broker. And the conversation is short, and because I'm obsessed with two ideas, one, the 100 beggars, and the second one I'll bring up in a second, but how would you live your life if you were an immortal? And she is told that she might need to wait for the stock to work out. And she says, I can wait. But she's the only one in the room that knows that she's not going to age and live open-endedly. I'm not going to give away the end of the story, but I watched that and I was thinking, oh, wow, this is 100 beggar or maybe more. Conversation that somebody snuck into the script of the movie, but it got my attention. But anyways, I was thinking, if you extrapolate this idea as a mental model, like if we were to live an immortal life as investors, and not in the sense that we would, age to 90 and be preserved, but stop aging at, 40, 50, whatever it is, we would think about investing differently. We would think about, I have time, the way she does in that movie. I have time.
Totally would. Yes. And that's how to create that mindset, or how to get over the short-termism. I mean, that's something that's worth spending some time, thinking about for yourself, how to do it. I mean, it makes me think, too, the coffee can idea that I talk about in my books, which is the idea of creating a portfolio that you buy and you leave alone for 10 years. It's like a commitment you're making up front to yourself that you're going to leave these alone. That's really just a crutch, right, to kind of force you to wait. Then there's lots of little tricks, too. I know Phelps in his book where he used Pfizer as an example, where he shows a table with just some very basic financial data, like earnings per share, ROE, and he just puts it year after year after year, and he says, if you own this business, would you ever want to sell it? And the answer, of course you would. Every year is, it's not like earnings go up every year, but every year you can see it's a healthy business, return on equity is good, so on and so forth. And of course, the stock goes all over the place during that period of time, but ultimately winds up going up 25 times, or whatever it is. It wasn't even that long a time period. I think it's just a decade or so. So, I mean, that's a good mental, kind of experiment too. Yeah, if you did live for a little long, how would you do it? I mean, anything that gets you to think, stretching out your horizon, I think is positive, because there's so much. Almost all of our culture and society pushes you to think otherwise. The daily drumbeat of financial news and economic reports and all the research people churn out, it makes you think something very important is happening all the time, and you have to be aware of it. But you really don't.
I think Nick Sleep said that news is just that. It's new. But does it mean it's relevant? Not necessarily. It's just new. Something new we just heard
I think
today.
of news as this, like it's a created product. It's there would be no news if, to think about, if we didn't have all the media we have now, there would really be no news. I mean, it would just be stuff that happens locally around you. So it's, there's still there still has to be some human being has to decide what's newsworthy, what's not, what drives them to make that decision. Once you really think about that, it's kind of hard to trust news at all.
No, it's not helpful. And then there's the idea of a shelf life of the information, right? Is this something that you and I will talk about 5 years from now and say, oh, this was actually meaningful, or not? And if it's not, then it's out the window. And with that immortal time perspective, as a family, you could say that they have an immortal perspective, infinite investment horizon, right? But I think it's tricky when it's not just you, it's the next generation. It takes a whole different way of thinking, that you realize you're planting trees for others to enjoy. And I know people that think that way, but it's a huge ask. So that's why for a second I asked people, if you were to live an immortal life, which is already a stretch, then you would be the one benefiting, how differently you would look at investments. And for me, it's a massive filter. Anything that's a 10% upside, 20% upside, it's a waste of time. Don't even mention, right? Move on. And you immediately lean towards something that it's the Xerox in the 1940s or 50s, whenever it was, when you feel like...
Yeah, not only that, but apply that same sort of thinking to what you read generally, what you're willing to even allow enter your mental space. Suddenly a lot of stuff falls by the wayside.
And it's also a play on time and money. So if you have this unlimited time, you think, oh, I can just waste it. But I think maybe that's at the beginning. You feel like I can just waste it, in the sense that I'll take the minimum wage job and just work all year. But then you realize, what's the point? I'm not going to do that. And you start to respect the time, although you have unlimited time. And it makes me think of people that have substantial wealth. You would think, oh, they can just waste away money. No, they actually start to pay attention to where the money goes, because it buys them time. Like, it immediately makes you respect the money and time in a different way. I think as a shortcut here, I would say that if you have less of both, then you don't respect it as much. If you have more of both, you start to respect it a bit more, especially when you think about losing it and not having any of it and having to start from zero, which is something that Charlie Munger and Buffett talk about, starting from zero. It's not something they ever want to experience again.
That's right.
I think it's a very powerful lesson for anybody that has any wealth, but especially substantial wealth that they can't replicate.
Yes, and I think for the families, at least the one I'm thinking of, families I'm thinking of, they've had to build that wealth over a long period of time. So they remember when, grandpa didn't have much or whatever it was. So I think you get a greater appreciation for that too. Versus if you just have it suddenly fall in your lap, you might think differently about it.
We have more respect for it. And most of the wealth that you and I think about is wealth that took time to be
built
created.
up over a long period of time. Exactly, yes.
But here again, the media makes us believe that it's all almost like a lottery win. It just happened overnight. But that's a shortcut, and it's not entirely accurate. There is another quote, another story that you mentioned in the Dear Fellow Timebinder. You bring up a story of a sage, and I'll do my best to pronounce the name properly. It's Nisargadatta Maharaj, who grew up in a humble tenement in the back lanes of Bombay. You write in your book. And he said that nothing in existence has a particular cause. And I went back to my notes, and it really made me think, because we're looking at the investment world as, what's the reason? The market is up because the rates are down, or the market is up because unemployment is up, or whatever, or gold is up because of this or that. But he says there's no particular cause. I want to bring it up because I had Peter Atwater on the show, and he wrote a book, Confidence Map, and he basically says something along the same lines of relaxing this idea that everything has to have a particular cause. Sometimes we just don't know.
Yeah, exactly.
Is that how you look at it?
We just don't know, or there are many different causes, or the sense that it's just question the idea of cause anyway. It's like, because it's an infinite regress question in a way. What caused X, but then what caused that, and what caused that, and what caused that, and you're just going all the way back in time, and all these other factors start to come into play. So it makes you appreciate every event as the result of many, many, many factors that have been at play for a long time. And it's not like X causes Y. It's that a lot of things had to happen before Y. And we may not know what those are exactly, and just to be comfortable with that. I mean, it doesn't sound like much, but I think it's a big idea, because then you don't have to constantly hunt out explanations for things that happen and find why. You just sort of deal with it, go with the flow. What happens, and you go from there.
And here I think, again, we want to know for sure, why did that happen? And I think media steps in here and tells us why. Why was the market up today? And they always find a reason why. It doesn't really
always
matter.
Yeah, that's it.
But can you tell me if the market will be up tomorrow? Nobody can tell. But at the close each day, there's a commentary.
We have the
smart
story.
People, right? There's always a story. And I think as humans, we just want to know. And
we love stories. Stories explain things.
And we can't tolerate uncertainty. If I was to go out on TV and say, I just don't know, Chris and I spoke today, we just don't know why the market closed up today. First of all, I don't think we would get invited again. And second, I don't think people would appreciate our feedback, but that's how we feel about it. I want to bring up something else that really struck a chord with me as I was rereading your book about the 100 beggars. You say that you don't recommend taking on startup risks in the coffee can, in the portfolio. And you say that you would stick with more established companies with long runways. We spoke about runways of growth ahead and ability to keep compounding capital at the high rate. I do want to bring up the startup risks because I feel like we've seen in the last few years, and I'm sure will happen again, more companies that get listed that don't really have an established business model yet, as in sustainable profits and loyal customer base and on and on. And you might think, oh, I'll find 100 bagger among those. But you take on what is traditionally seen as a venture capital startup risk. You don't recommend it.
Yeah, and part of this was when I did the 100 bagger project, I wanted to try to find some traits that might be predictable, things that you could look for. And obviously, maybe not obviously, but with startups, you can't know. It's more of a roll of dice. It's just a lot more unpredictable factors involved. So it seemed to me anyway. Mm-hmm. So even when I did the 100 bagger study, I took out a lot of like the little micro caps and companies that were just, there's always these little natural resource companies that trade for 12 cents and, suddenly become $3 or whatever. Mm-hmm. I didn't really want that because that wasn't necessarily something that a regular person could look at the business and financials and say, oh yeah, this is something that could be really big. Like if you were looking at a McDonald's and they had 100 stores and say, yeah, why can't they replicate this across the country or whatever it is. That's what I really wanted to focus on. Because I think from that process, you could build a repeatable sort of investment process around finding those kinds of things versus trying to find the startups require, I think, much more names. Mm-hmm. Maybe you have to make 50 bets before mm-hmm. you get that 2 or 3 that really pay off. And that's the way a lot of the venture capital funds are structured. They're taking a lot of bets. Mm-hmm. Where I think investors, we don't really want to take that many bets because we want to understand our companies, and it takes time, and there's a cap to that, how much attention you can put on, how much you can really learn about so many companies. So, yeah, I think that's the reason to stay sort of focused on more established businesses and that their traits that are somewhat more predictable.
And when you look at the success stories of today, somebody brought it up and I found it really interesting. How would you know? As you said, 100 stores, or when they were a fraction of the size that they are today, how would you know? And you would be looking for this indicators of potential future success, being directionally right. Would you know that it's going to be 100x? Probably not. But you would know that, look, they're making customers happy. Customers come back. They provide value. They are able to source better and better with size and so on, their scale. They're focused on cost and efficiency. They are finding the right locations, whatever it is. They're treating their employees well. And you're kind of adding those things that you can actually evaluate, but you can't tell for sure what kind of upside is available in this stock. But I like this idea, would I know, right? And with some of the high risk, high reward scenarios, I just would never know. And if that's the case, you never know.
And to be fair, on some of even the higher quality names we like, again, being directionally right, but there are things that happen that you would never possibly be able to know. I mean, mm-hmm. I always like to use the example with Apple because they just invented whole new categories that didn't exist, So it's not like you could have predicted the iPhone if you owned it, 25 years ago. Mm-hmm. Or with Amazon suddenly getting the AWS, you wouldn't, mm-hmm. when they were just selling books, it's not like you would have predicted that. Mm-hmm. So, but great companies with those kinds of founders that we love, entrepreneurial, sometimes you get some nice positive surprises. They create whole new verticals and businesses grow out of their existing business that you would not have been able to predict. So there's mm-hmm. a certain wild card possibility even there that can really help you along.
If it's on the upside, that's great. If
it's something on the upside, we love it.
Another product line, more markets, a higher price point, we're welcome. We welcome those events. Speaking of passing ideas across generations, in the time binder spirit, in your book, 100 Bagger Book, you have a quote from Phelps, who quoted George F. Baker, who was born a little short of 200 years ago. To make money in stocks, you must have the vision to see them, the courage to buy them, and the patience to hold them. And then Phelps says patience is the rarest of the three that you write in the book. I know the answer, it still holds true, but I'm curious, how do you find, cultivate, and practice patience in this impatient world? What are the tips you would have for the audience?
Well, I think the number one thing, and I kind of hinted at it before, is to be very mindful of what you even allow yourself to be exposed to.
Mm-hmm.
I don't have CNBC on or any of the other financial programs on. I used to read, the Wall Street Journal, Financial Times every day. This was years ago. I haven't read them in years, but I don't do that anymore.
Mm-hmm.
I don't read the daily financial news with the roll call of what happened that day.
Mm-hmm.
So a part of it is shielding yourself from even those influences, because they almost like they have a little bit of a power of magic, the way they can enchant you. So don't even look at it. There's a lot of macro pieces that get tossed around all the time. I have other hedge fund friends, and they pass these things around, these PDFs. I'm sure you've seen them.
Mm-hmm.
Rather long reports about some grand theme. I don't even read them most of the time. I just it's going to be noise. So I really just try to focus on those things that I think will matter. 5 years out, 10 years out. What are the things that are really important? And when you do that, it screens out a lot. You don't care about what the latest CPI number is. You don't care what the Fed says. You don't care if the Fed's raising rates or dropping rates. It doesn't matter. You're not going to be talking about it 10 years from now.
No.
So if you're really disciplined about that filter, that alone, I think will help you. It will help.
What do you do not to sell an idea too early?
To not sell an idea too early. Yeah, I often say this, like with selling. In my prior books, I know I've written this, where it's the most difficult thing to selling. Mm-hmm. Well, no one's really a good seller, and especially people who own the kinds of assets we do. Selling is almost always a mistake. Because the asset's going to be worth more at some point, in the future. It's more a matter of, all right, you took it off, you sold it here, and what did you put it into? And then you kind of compare, those two. So I think about it that way sometimes. But that is very hard, Bogomil. That is very tough. I just fall back on the usual things, which is if you focus on the business and you allow for some disappointment, knowing that's going to happen. There's going to be off years for your business. Being tolerant of that. And as long as the most important factor, so as long as it's still compounding capital, or at least shows that maybe this year's not going to be good, but if you think it can get back to that, as long as it's still compounding capital, high rates of return, still has that competitive position, you still got your management team that you like, their incentives there are right, yeah, you're going to have to let it go. I think it's almost always better to err on the side of holding it too long than selling too soon.
A couple of thoughts come to mind. On one hand, you would like to have new capital coming in, so you never have to sell the original, right? Which is an experience for a lot of people that are maybe saving consistently, and they just add the same way as the original coffee can story that you brought up. And second is having some sort of a rule that you won't sell for a period of time, but you will get tested, and it's very tricky. What I notice with a lot of guests on this podcast and friends in the business is that actual investor types that want to own businesses really dislike the trading experience. Like they don't like it, and it's hard for them. And I have friends that don't even log into their trading platform for weeks or months. They don't
That's
like
me.
it.
Yeah.
That's you.
Yeah.
And I think there's something about it that in your DNA, you just don't feel like it. Like you bought it, you like it, and you don't want to go and touch it, sell it. And the whole industry, as we spoke, is built around activity. No, come back, sell, trade, because that's how commissions are made. But that's not how the big money is made. It's made of holding. So if you have that gene of, I don't really feel like trading, this can actually help you.
I know even when I when I do finally have to go in and sell something, I don't like it at all. My whole body, I react. I don't like it. I don't feel good doing it. It's just, I like relay, and I finally go and log in and do it. And it's just, it's a whole thing. So, I've trained myself to know that, it's probably a mistake, or you better have a very, very good reason for doing it,
Chris, I want to ask you about quality. And I've been rereading Robert Pirsig's book, Then in the Art of Motorcycle Maintenance, and I'm sure you're familiar with it. I was also reading his book, Lila, that Chris Bagg, who teaches the original security analysis course, told me to read. I got to see him recently. And I'm also reading his Pirsig's essays on quality, where he talks about the writing experience, which is fun to see, kind of a look behind the curtain, how the books came about. But he chooses not to define quality. And that's why I'm bringing it up, because it rhymes with the general semantics. And actually, at the beginning of one of your books, you say quality as a term can be ill-defined at best. In Timebinder, you write about it. And it really struck a chord with me, because we talk about quality, investors talk about quality. I think Bezos said quality is something that you just experience. You don't talk about it, when he talked about Japanese manufacturers. In Search for the 100 Beggars, are you searching for quality?
Definitely. Yes. That's what it's all about. And it does have a certain undefinable aspect to it. A certain, almost certain, you just experience it and know it. There's certain things we can talk about, right? We can say high returns on capital. We can talk about the incentives. But there is some other quality to it. Pun intended.
Right.
I mean, I do think that's true. And I've tried different ways to describe quality, in different ways, try to pin it down, even as far as thinking about, all right, well, what does it mean? What does it mean for the employees? And you say, okay, well, there's probably low turnover, and you try to identify certain things, or even relationships with suppliers. You say, okay, well, they probably have good long-term relationships there as well. But still, you can write all this stuff out, but still doesn't quite capture it. You'll know it when you see it. Really high quality business.
It makes me think of Phil Fisher, Common Stocks and Common Profits, a book that is not brought up as often as it used to be, but he would go around and ask suppliers, customers, anybody that interacted with the business, and collect those qualitative impressions of the business that would not be exactly captured by the balance sheet and the income statement and the cash flow statement. Although I think the three are very helpful, but they don't really tell you the full story. I think you need a lot more context to see, is it sustainable? Is the business getting bigger and better over time? Are they doing something that is a shortcut for now that makes the numbers look better? And on and on and on. But you realize, I'm a numbers guy, so I wish there was a formula, but I know there isn't any. So I grew to appreciate that nuanced aspect of it, and general semantics gives me permission to explore it more. That some things I don't know for sure, but when you're in the presence of quality, you just know. I want to briefly bring up a conversation I had with Derek Sivers, and I don't know if you're familiar with his work, but he wrote a book recently, Useful Not True, where he talks about beliefs that we have that are useful in our life, but they're not exactly true. And it made me think of the conversations we've been having. And in life, one of the stories that he has is, you go into a room and you say, I'll find a friend in this room. And you go in with a whole different attitude that you will find a friend in the room. But if you actually question me, you would say, well, it's not true. William Green, who wrote Richer, Wiser, Happier, told me you can see life as everything being a miracle and nothing being a miracle, which I brought up to Derek Sivers. And I like to see everything as a miracle, even a small one. But Derek told me, it's not true. I said, it's useful. And I'm just thinking about investing in life, how you think about the beliefs that you hold with the knowledge you acquired for general semantics. Do you think that you have some beliefs that are not true, but you find them useful?
See, I would almost like to do away with the aspect of truth altogether. And just say things are useful. And I've been influenced on this some way there's a philosopher named Richard Rorty, an American philosopher. And he died some years ago, but one book in particular that I like to recommend because it's very short, but a lot of good, thoughtful things in there. It's called Philosophy is Poetry.
Mm-hmm.
And the idea is that I'm going to greatly summarize and distill what he had to say, but the idea that you should read these philosophers not as if they are telling you something that is true, but as you would read poets. So you're reading them because the ideas are attractive in some way, or they're useful to you, but that no one has that. No, there's no final arbiter. So because what he was against is the idea that when you say something is true, that gives you somehow permission to stop talking about it. It's true.
Mm-hmm.
And he wants you to say, I remember there was one line in his book where he says, the answer to a great poem is another great poem.
Mm-hmm.
So, the answer to something you think is true, you can say it again different. You can say different things. There's another line in there where he says something like, there's nothing that we can talk about that we can't talk about differently.
Mm-hmm.
I like that as well. It goes against this idea that you're fixing something as being true. You're just holding it as a kind of tentative belief.
Mm-hmm.
It's useful for whatever reason now, but you're open to perhaps a better poem. I've always liked that from Richard Rorty. So that's what I would say about that, I think.
I really like that because it's more nuanced. It's like saying, value investing is true. Well, what is value investing? Certain ideas that we consider value investing are useful, right? A certain set of beliefs that I think of Charlie and Warren that taught us certain things about how the business should be run, what is price, what is value, how to think about it. So these are useful ideas, but I think it's helpful not to see them as almost religious truths, but more as mental models and tools, maybe poetry, as you said, that could guide you in your life. But if you have to change, adapt, and morph into something else on the way, then do that. And it might not apply to your life, and even the expression of those ideas in your life might be different than mine. That's why two friends in this business might have portfolios that are completely different. One has 4 stocks, the other one has 50, right? And they can still have a nice meal together and like each other, right? So it's
right.
And they have no overlap between portfolios, although they think that they are following similar principles. I usually close those conversations with a question about success, but I already asked you that. So today I want to ask you about failure. And the reason I want to ask about it, because in the Dear Time binder, you have a quote. A feeling of failure comes from a gap in what you expected or wished for and what you wound up with. And it's something that I find fascinating because through life we're trying to pursue something and our expectations get always often inflated. I don't want to say always. You should catch me there. But the gap gets created. How do you think about it in terms of life and investing? You go in with certain expectations and you have to keep them in check, even with the 100 beggars.
Yes. You can't help but develop some expectations, and that means invariably that you're seeding some disappointments along the way. Mm-hmm. There are times when you're surprised, when your expectations are exceeded, of course. And then there are times when they are not met. So I think the key about the success and failure, too, is that they're your own definitions. They should be. Mm-hmm. And so, what's a success and failure will be unique to you. When I think what would be a failure would be if I'm living my life in a way that I really don't enjoy the time. Mm-hmm. That would be the failure. Mm-hmm. That would be an awful failure. But yeah, managing expectations is important because you get excited about businesses. You think they're going to do wonderful things, and if they don't, you might get disappointed. But I don't know. I don't feel like I know in the 100 bagger book I talk about if you fall short of the 100 bagger, you shouldn't worry. If you get 50 extra 25x, it's still pretty darn good. So a little perspective, I think, helps on those questions.
I think it's okay to aim high.
Yeah.
But if you don't make it all the way, hey, it's not bad at all. You had
a good time doing it and trying.
Exactly. Enjoying the ride. Chris, this was a blast. I really appreciate your time. coming back on the show and helping me bridge some of the ideas across all the books and conversations we've had and some of the inspirations I've been collecting. And I still catch myself using absolutes, so I'm still working on it.
Well, it's always good to talk to you. You always have very good, thoughtful questions, so I appreciate you, reading the materials carefully as you do. And yeah, I mean, it's a great conversation, so thank you again.
And I highly recommend all your books, and they're just wonderful. And you introduced us to so many new ideas that I think a lot of people would find helpful, not just investing, but in life. I think any mental models can help us on this wonderful journey that we're all on. And I like the idea that everything is a miracle. And I don't know, William Green's perspective is very inspiring. Even if it's not true, I find it very useful. So, Chris, thank you so much for this little miracle today. I really appreciate the time we had together. Thank you so much.
Thank you.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.